Other income, which includes finance income, has seen a growth of around 9.5%. Let's welcome in Veer Advani, Managing Director at Blue Star. Good morning, Veer, and welcome to the show. A mixed set of numbers that we've seen this time around. What has led to the dip with regards to where profitability goes?
Sure. Good morning. Thanks for having me. I'll just walk you through the numbers. You're right, it is a mixed quarter. Revenue grew 21.5%. EBITDA about 19%, but PBT before exceptional only 8%. On the positive side, segment 1, which is our electromechanical projects and central air conditioning business, had a very good quarter. Revenue grew 27% and operating profit also grew 27%. Order inflow has also been healthy in that segment. Segment 3, again, we had a strong quarter. Revenue is up quite a bit. Profitability is significantly up. We've turned around that business and it's well on its way for a great year. The challenge has been in segment 2, which is our unitary products business. You know, that houses our room air conditioner business and commercial refrigeration business. So what's happened there is that while we were able to bring in some revenue growth, about 9%, operating profit has actually halved nearly to about 8 crores. Now, what's happening there is that there are margin pressures, gross margin pressure in the room AC business, largely on account of a lot of inventory in the industry as well as with Blue Star. So market operating prices have fallen. We've also had to reduce prices to liquidate the inventory. So gross margin has been under pressure. In addition to that, operating costs have also been an issue because of the high inventory that we're carrying. Both finance cost as well as warehousing has gone up significantly. So as a consequence of that, segment 2 profitability has been impacted. So that is really the reason for segment 2 sort of mixed performance.
As we are saying that with regards to where room ACs is concerned, that has been weak. Similar was the scenario that we saw in the first quarter as well. Now, is that actually impacting your working capital, leading to a higher debt picture as well this time around?
Sure. So I'll explain. Q1, we actually had degrowth in the business in room air conditioners, and we were carrying fairly high inventory. We had told you that we have excess inventory to the tune of about 150 crores in the business. We have managed to liquidate half that inventory in Q2, but we are still carrying significant inventory. Definitely, that has increased the overall working capital in the company, and consequence of that, of course, is finance cost and borrowing. So, however, having said that, I want to tell you, Q1 we had degrowth. Q2 in room air conditioners we had volume growth of 14%, which was much higher than the industry. Q3, which is the real festival season this year, we are looking to do about 20% growth, combination of inventory liquidation as well as expectation that the festive season should be better than H1. So I think it's a combination of our own interest to liquidate as well as an expectation that the market should be slightly better than we've been seeing in the last few months.
Right, so Veer, how much has your debt increased during the quarter? Because the finance expenses have gone up by almost 100% at 11.5 crores versus almost 6 crores. How much has the debt gone up by?
So the debt level is about 500 crores at the end of Q2, which is roughly where we were at the end of Q1. Compared to Q2 of last year, you're seeing this increase. So last year, same time, debt level was about 250 crores or so, more or less, if I recall correctly. So debt has gone up by double. And that's largely on account of inventory we're carrying and some amount of debtors.
Right, and do you think this is going to be a manageable level and current, debt level will be maintained in FY19, or do we see any repayments happening in the second half of FY19?
So firstly, just so we're clear, even at this level, our debt equity is only 0.6, so it's not a major concern for us. Of course, having said that, we always like to keep the balance sheet lean because margins are always under pressure. So we have a very clear plan to bring down borrowing to 300 crores by December. And by the year end, we'll be at about 250 crores, even though it'll be at the peak of the season. So we have a very clear focus on bringing down debt at this time.
Right. And we're overall in terms of FY19, what's the outlook looking like? Because you have been investing in the water purifier business. Brand building is something that you have been focusing on as well. Will that keep your margins under check throughout in FY19 at current levels? And secondly, with regards to where exports and new product segments go, what's the update on that front?
Good. So as far as outlook is concerned, we on the room air conditioner business, which may be of interest, we are at H1. We are sort of zero growth in revenue, where we've reached H1 of last year from a degrowth. We're looking at a 20% standalone growth in Q3. So for a full year period, we're looking at a 10% growth in revenue. With that, we're looking at a operating margin in segment 2 of about 9 to 9.5%, which is about 0.5% lower than last year. So we will be catching up on our profitability as well in H2. That's point one. Second point you asked was on water purifiers. Business is doing well. We've sold 35,000 units in this year. And we're on track, as we had mentioned, to do about 100 crores in business for the year. Brand building is continuing, and we are making progress in our market share aim. Overall, that 9 to 9.5% operating profit of segment 2 includes a loss/investment of about 1.5% on account of water purifiers. So we're more or less on track with what we've been conveying. Overall, for the company, I think the only new thing is this with the NBFC liquidity crunch. We had hoped that H2 would be a strong order inflow period, ahead of the general elections. We're a little cautious on that right now because obviously developers do rely on NBFCs for financing. So we are keeping a careful watch on our customers as well as inquiries to see how order finalizations pan out over the next 3 to 4 months.
Right. All right, Veer. Pleasure speaking to you, and good luck for the coming quarters as well. The stock has been trading under pressure, but it has been an erratic monsoon, as well as in terms of the summer, the demand has been muted, which has not only affected Blue Star. I think 31 to 33% is the kind of cuts that we've seen on the counter on a one-year basis. But you have other companies as well, for the likes of a Whirlpool, Symphony, which have been trading under pressure. Mainly, the entire sector has seen cuts during this quarter. But let's quickly slip into a short break, and then we connect with Rupesh Shah, Executive Director at Symphony, for a fine print of their quarter gone by. Please stay tuned.